Friday changed what the market believes about the Fed. The US economy actually lost 23,000 jobs in July, and the previous 2 months were revised lower by another 103,000 jobs. So that was enough for traders to immediately price a lower chance of another Fed rate hike in September. And that is exactly why Wednesday's CPI report matters so much. Because if inflation comes in soft, then it supports a move that the market has already started making. But inflation comes in hotter than expected, then markets may suddenly have to unwind part of that move. So Friday, the weak jobs already set up the sentiment that there's going to be a more dovish Fed pricing. But Wednesday CPI is either going to confirm or challenge that. So that difference matters a lot in a week like this, because the outcome that is most likely does not always create the biggest market reaction. So let's walk through the entire setup. What changed after the jobs report? What bonds and the dollar are telling us? Why gold and oil are sending very different signals? And what institutional positioning may be telling us about risk? And then I'll map out what a soft, normal, or hot CPI could mean for stocks, gold, the dollar, the yen, and small caps. So let's start with what actually changed on Friday. So let's take a look here. We have payrolls sitting at negative 23,000. May and June revisions combined were negative 103,000. Unemployment is sitting at 4.1%. Participation rate is sitting at 61.4%. And the wage growth is sitting at 3.2% year over year. So the headline number was negative 23,000. But for me, the bigger issue is that the previous 2 months were always also revised down by another 103,000 jobs. So we're not just looking at 1 week month, we're looking at evidence that hiring has been softer than the markets previously thought. Unemployment coming in at 4.1%, and the labor force participation sitting at 61.4%. And then wage growth also slowing down, as you can see, down to 3.2% year over year. None of that automatically tells us that the economy is falling apart. But it does weaken the argument that the labor market is still running so hot that the Fed needs to keep tightening aggressively. And that's the important part. When we take a look at the 2-year Treasury yield, that's the first chart that I want to show you guys here. If you're new to the macro side, here's the simple version of this. The 2-year yield is one of the cleanest market indicators of where traders think that the Fed policy is going. If traders suddenly expect that the Fed is going to be more dovish, then the 2-year yield will usually fall, and that is exactly what happened after the jobs report on Friday. The market started pricing less risk of another September hike. Now, let's take a look at DXY, which is the dollar index. The dollar also moved lower as traders reduced expectations for tighter US monetary policy. Again, the connection is pretty simple. There's a lower expected US rates. That sentiment sets up less yield advantage for the dollar, which puts more downward pressure on the US dollar. Now, let's take a look at equities across the board, starting off with US 30. So on Friday, we pushed up bullish, and then right when the jobs report came out, we started consolidating, but nonetheless, we did end up closing bullish right here. Same thing with Nasdaq, where we started to push back up. Jobs report came out, and we started closing back up bullish. Same thing with small caps here with Russell 2000. This is where the jobs report came out, and we still ended up closing bullish. And S&P 500 essentially doing the same exact thing, where the jobs report came out right here, and we ended up closing bullish. So stocks responded positively. Now, if you ask why, it's because lower interest rate expectations can reduce financing pressure and raise the value that investors are willing to place on future company earnings. So that is particularly important for growth stocks. So Friday's basic chain was essentially, we got weaker jobs report, which put less pressure for Fed hikes, and that made the yield drop lower, the US dollar drop lower, and stocks to push back up higher. So that's the baseline that we're carrying into this week. But now we get to the part that matters the most. One of the biggest mistakes that traders make before economic data is asking only one question, which is, what number do I think is coming? Rather, I think there's a better question that we should be asking, and that is, what outcome would actually force the market to change its mind? Because those are not the same things. When you're looking at probability, which is the first question, you're essentially asking what outcome seems most likely, versus your best payoff is going to come from asking which outcome would force the biggest repricing. Friday already pushed markets towards the more dovish side. So imagine that CPI comes in soft. That is essentially going to support what the traders just started pricing as of last week. Potentially bullish, but not necessarily surprising to the market. Now imagine that CPI comes in meaningfully hotter than expected. Now suddenly the market has to deal with weaker employment, but inflation that's still not cooling enough. Now that could force the traders to reconsider how dovish the Fed can actually be, and that's the asymmetry that we're watching going into Wednesday. But before we map the actual scenarios, I want to show you why the cross-asset picture is not as simple as bad jobs, Fed is dovish, so you go ahead and buy everything. And for that, we're going to take a look at gold first. So let's take a look at gold on the daily time frame. You can see that for the last approximately 4 to 6 weeks, gold has been consolidating. And then just last week, gold gained more than 7%. That's an enormous weekly move for an asset like gold. Now, don't make the mistake of saying that, gold rallied, therefore a crisis is coming, because historically, market has always looked at gold as a safe haven asset. So if there's any sort of uncertainty or the market pricing in that there's crisis coming, then you'll see gold pushing. Markets are never that simple. And I'm sure that we have learned it already 8 months into the year. But when gold makes a move this large, we should want to know what else is happening around it. So now we're going to compare that with oil, US oil WTI. Oil was moving in the opposite direction as part of the geopolitical premium was already coming out of crude. So essentially we had gold that was strong, but we had WTI that was dropping, oil that was dropping. Now that matters because gold and oil can both react to inflation, but they're not identical assets. On one side, you have oil that is heavily influenced by energy supply, geopolitical risk, and global demand. And then you have gold that responds much more directly to things like real interest rates, the dollar, central bank demand, currency risk, and just broader demand for monetary protection. So when oil is falling while gold is surging, you automatically do not want to call that an inflation trade. Instead, the question is, what is gold responding to that oil isn't? So that takes us back to the bond market. When we're looking at the 2-year Treasury yield, this is telling us on the 4-year or on the 4-hour or on the 1-hour time frames, that tells us a lot about expected Fed policy. The 10-year starts adding a little bit more information to the picture, things about the economic growth, inflation expectations, and how much return investors demand to lend money for longer. Then you add the 30-year yield to that, and that takes you out even further. Now you're looking at long-term inflation, government borrowing, fiscal concerns, and what investors want to be paid to hold U.S. debt for decades. So essentially, the 2-year is going to tell you the Fed expectations, the 10-year is going to tell you the Fed plus the growth plus inflation, and the 30-year is going to tell you long-term inflation plus the fiscal or term risk here. Now, retail traders will often look at these as 3 random bond charts. You don't want to do that because they help tell us which part of the market story is now changing. If CPI is soft and the 2-year falls, then that makes sense because now the markets are pricing a more dovish Fed. But imagine that the 2-year falls while the 30-year stays stubbornly high. That's a completely different message in the market. That would tell us that, okay, markets believe that the Fed can become more dovish, but investors may still want extra compensation to hold long-term US debt. And that's one reason that we're going to be watching gold alongside bonds this entire week. Another thing that I want to include here is going to be this article. There's also a second order connection basically happening between Japan, the yen, and the US Treasury market that I think is also very important and worth understanding. The US and Japan recently coordinated intervention in the yen. Japan also holds a very large amount of US Treasury securities. Now, the important part is that when a foreign central bank needs US dollars, one option is selling dollar assets like treasuries. But there's also another mechanism here. So essentially, what we're looking at right now is foreign central bank, and that provides treasuries as collateral. Then you have something called the Fed FEMA repo facility, which provides temporary dollars and that helps the central bank get US dollar liquidity. The Fed's FEMA facility allows eligible foreign central banks to temporarily exchange Treasury collateral for dollars. Now, why does that matter? Because it can reduce the need to sell Treasury securities directly into the market just to raise dollars. And I want to be very clear about what I'm saying here. I'm not saying that the yen intervention secretly happened to protect the US Treasury market. We don't have any evidence to make that claim. What I am saying that is backed by the information that we have here is that currency intervention, dollar liquidity, and the Treasury market liquidity are all connected. And that's the institutional plumbing underneath the markets. And knowing those connections will help you understand why sometimes a move in USD/JPY can matter far beyond just one forex pair. If you haven't already, a couple of months ago, I published a video on YouTube with talking about USD/JPY and how it can have a cross-asset impact. That's essentially what I'm talking about. So because of that, USD/JPY this week is going to become a very interesting pair that we're going to be watching, because US yields and intervention risk can pull it in opposite directions. So we'll come back to this when we map out the CPI here. So now let's talk about institutional positioning. But I want to approach this a little bit differently than most financial social media would. And I'm not interested in telling you that smart money knows something that the retail side doesn't. That's usually oversimplified. But essentially the question that I'm asking and that we will be answering here, just looking at the data points, is going to be, how were large participants structuring risk before the catalyst here? So before NFP was released. Now we're going to take a look at the options data here. So the most important thing here isn't even the ticker, it's essentially the timestamps of the dates that we're looking at. These trades happened before Friday's employment report. Now, that does not mean whoever placed them knew what the payrolls would be. That's not what I'm claiming here. It just tells us that some larger participants were willing to take meaningful exposure before the catalyst rather than waiting until the story became obvious afterwards. So that's completely different. Professional risk-taking is often about just preparing scenarios before certainty arrives. That's the same type of behavior that you can essentially expect going into CPI as well. Now, looking at the put selling transactions here, here's basically the retail-friendly explanation. When someone says that they're selling a put, they're generally saying that I'm willing to take the risk that this market stays above a certain price, or I'm willing to own exposure at lower. Now, that can be bullish or more like a neutral structure. But the important point here is that one option trade will never tell us the participant's entire portfolio. They could be hedging something else, or they could be part of a larger multi-leg position. So we're essentially not looking at one option trade and saying that, institutions are definitely bullish. Instead, you're looking for patterns here. Now, compare that to the price investors are paying for downside protection on SPY. If the skew remains elevated, that's telling us that downside insurance is relatively expensive. And I think the combination basically gives us a very useful principle here. You're long the base case and you're protecting against the tail here. So you don't need to copy the trade, right? Copy the thinking here instead. Before Wednesday, the questions that we should be asking is what's already priced in the market, what outcome would surprise the market, and what happens if your viewpoint is wrong. So that's a much stronger process than just trying to guess, one CPI number here. Now let's actually build Wednesday's map here. Let's take a look at Forex Factory real quick and come over to this week. So on Wednesday, we have CPI coming out at 5:30 a.m. PST or 8:30 a.m. Eastern time. And then on Thursday, we have PPI coming out. And on Friday, we're ending off with retail sales. First, one clarification. CPI is extremely important for markets. We all know that. But CPI is not technically the inflation index behind the Fed's formal 2% inflation target. That is PCE inflation. So CPI still matters enormously because it's timely and markets watch it closely, and a meaningful surprise can immediately change expectations for the Fed policy. So Wednesday at 5:30 a.m. PST or 8:30 Eastern time, this is what I'm watching. If we get a softer CPI, that is going to put less pressure on the Fed. That is something that the market is already starting to price in a little bit, which means that we're expecting that the 2-year yield is going to drop, the US dollar is going to drop, and stocks, gold, and rate-sensitive assets are going to get support. My first confirmation here is going to be the 2-year Treasury yield. If CPI is clearly softer than expected, I want to see this dropping down even further compared to what happened with NFP, because now you have NFP and you have CPI, so drop us down closer to the 4% area. If rates don't react, then this is going to be more of the information that we're looking at. Then the dollar, if rate expectations move more dovish, then same thing, I'm expecting more downward pressure on the dollar to break the previous lows here that it created when NFP came out. For Nasdaq, we're looking at, or even QQQ, lower yields can be supportive because high growth companies are more sensitive to interest rates. Then same exact thing with small caps. Small caps may actually be one of the more interesting confirmations. Small cap businesses tend to be more sensitive to financing conditions. So if markets genuinely believe that rates are becoming less restrictive, then I want to see whether small caps will participate. If Nasdaq rallies or QQQ rallies, but IWM or Russell's cannot catch a bid even as yields are falling, I would be paying attention to that divergence there. Gold should also be a general benefactor of this from a soft dollar and lower real rate expectations. But there is one major caveat right here. Gold just had an enormous week. So good macro setup does not automatically equal good entry either. I don't want retail traders hearing that, soft CPI, bullish gold, and chase after a 7% weekly move without considering price here. So overall, that is what we're looking at when it comes to the soft CPI. Now, scenario 2 is, let's say CPI comes out exactly as expected. This is a scenario that traders will often forget exist. Everyone's going to prepare for the fireworks, right? The misses or the massive pushes, and then the number doesn't really meaningfully change the entire story. So if CPI roughly matches expectations, the first market move may actually reverse here. And that's where I care much more about the relative strength. So the question that we're going to be asking here is basically, does NASDAQ or QQQ, does it keep leading? Small caps, do they start catching up here? And does SPY hold a move? And also, same thing with gold. The main question here is, does gold hold last week's breakout even without another drop in yields? The dollar, if you're trading any of the currencies, you can also follow DXY. Does the dollar start recovering even though that the Fed story hasn't materially changed here? Those relationships become more useful than the headline itself. Now, scenario 3. This is a scenario that personally will interest me the most from more of a reaction standpoint. And it's not really because I'm expecting that there's going to be a hot CPI, which really I'm not, but because Friday already moves the market in the opposite direction. This is going to be a much harder Fed problem. If inflation surprises materially higher, then the market suddenly has to ask, can the Fed actually become as dovish as traders started pricing on Friday? Again, the first thing we're going to do is take a look at the rates. If the 2-year yield jumps, that's a clear sign that markets are rebuilding expectations for tighter Fed policy. Higher US yields would normally support the dollar as well. And then when you're looking at QQQ or NASDAQ, that becomes a headwind for high duration growth stocks like NASDAQ. Small caps can also struggle because higher financing costs will matter more for the smaller businesses. Gold is where we're expecting the reaction gets a little bit more complicated because retail traders will often think, higher inflation means that gold goes up. Not necessarily. If hot CPI sends the dollar and real yield sharply higher, then gold can initially fall. So I want to watch the entire sequence. If there's a hot CPI, then usually that would mean that the yields will increase. That means that the US dollar will also gain more strength, and then we're going to see initial gold pressure. Once we see the sequence, then we ask, does gold recover? If gold refuses to stay down, even while yields remain elevated, that would tell us something very different about demand for the asset. when we're looking at USD JPY as well, so these are some of the major assets that we're going to be watching out for this entire week. For USD JPY, hotter CPI and higher US yields would normally push the pair even higher. But there's a complication to that. We are now trading in an environment where actual currency intervention has already occurred. So the higher USD JPY goes, the more asymmetric relationship of the risk becomes. That's why I don't want someone simply looking at the chart and saying, hot CPI buy USD JPY. Instead, look at rate confirmations, look at the dollar confirmation, and the awareness of the intervention risk here. Another thing that we're going to be looking at here is going to be on Wednesday, you have the 10-year auction, and on Thursday, you have the 30-year auction for the U.S. Treasury refunding or the auction. There's also another piece of this week that you don't want to ignore. That's the main one. After CPI, the Treasury has a 10-year auction later in the day, and then the 30-year follows on Thursday. So why do you care? Because CPI primarily changes the inflation and the Fed conversation. But Treasury auctions will give us information about actual demand for the U.S. government debt. So imagine that CPI comes in soft, the 2-year yield drops, but demand at the longer Treasury auction is weak. That tells us that the long end is dealing with something beyond than just the next Fed meeting or September rate hikes and that debate. That's where the cross-asset analysis becomes a lot more interesting. And one correction here, just for precision, is that Treasury has not announced that it's reducing long-term bond issuance. Its latest refunding statement says that current nominal coupon auction sizes are expected to remain in place for at least the next several quarters. So if you see someone saying that Treasury officially announced fewer long bonds, that's not what the statement says here. So the last major asset that I also want to take a look at before we get over to the technical side is oil. And energy remains one of the variables that can complicate the entire inflation story very quickly. If crude continues falling, or if WTI continues falling, that helps the disinflation narrative. If geopolitical risk returns and oil suddenly spikes again, inflation expectations can become more complicated. So we're going to just keep oil on the dashboard. We're not really going to be trading it too actively here at the moment. So overall, looking at the 2-year yield, 10-year yield, 30-year yield going into CPI, that's the main thing that we're going to be watching, right? So first question for the 2-year yield is, did the CPI actually change the Fed expectations? Number 2 is the dollar. Is Forex confirming what rates are telling us? And then number 3 is we're looking at equities. We're looking at SPY. We're looking at Nasdaq and the small caps together. We're not just looking at, are the stocks up? We're instead asking which part of the market is leading. Then we're looking at gold. Is gold confirming lower real rate expectations or behaving unusually despite higher yields? Then finally, we're looking at USD JPY. Is the currency following US yields? And how is the market reacting as intervention risk stays in the background here? So that is from our main fundamental side. Let's go ahead and dive into our actual technical analysis. Start off on the weekly time frame for US 30. You got that top wick rejection. I'm just going to say 54,800. That's a little bit higher than the top wick rejection, but kind of sitting around there. For this week, we just started forming the bottom wick, so I'm just going to give it some room. What I'm going to do is drop down to the daily time frame and map out the previous daily candle low, the bottom wick rejection. Let's just say 750. Drop down to the 4-hour time frame, and on the 4-hour time frame, we have this consolidation that's going on since Friday. So if price continues breaking above this resistance, then we have those nice clean buy opportunities to the upside for a range of about 171 points, and then a continuation up into the next support for about 337 points. But our entire range here is for about 700 points. We also have a support formation here on the 4-hour time frame. If price breaks below this, you have an entire range for the downside for an additional 161 points. When I see consolidation on the 4-hour time frame, usually that just means that there's going to be consolidation on the 1 hour. We had a gap down when the market opened up, but now the market has for the most part filled in that gap. And even going into tomorrow, we don't have too much coming out. Even with JPY, you have a bank holiday. The red folders come in Asian session, but that's not really going to be impacting US 30. Let's come over to Nasdaq. One thing that I do want to do before we move on here is going to be to come over to DIA, go over to the daily time frame, and take a look at, these are our institutional supply and demand zones. So everything that we get on Sidekick in terms of the data points, all of that TranSpider will go ahead and map that out onto your chart directly. So any of the key levels where you have a lot of the institutional buy or sell orders basically placed, all of that's going to be mapped over onto your chart directly. So based off the daily time frame, there's a very strong supply zone that's sitting up top there, a lot of sellers. And the next demand zone is sitting all the way down here into 520. You just map up the same exact structure onto your daily time frame on US 30, and you see that where you have your massive sales pressure sitting down there, and then your buyers, of course, sitting right into this gap that we see from last week. But since we are scalping and even looking at some day trade opportunities, we care about what the price is going to do right now. So essentially, we're looking for price to come back and tap into that major zone up top here, and then look for some more sells to the downside. You can do the same exact thing when you drop down to some of the lower time frames. So here, right when the market opened up today, and even on Friday, you see that there's a demand zone. So you had some nice buy opportunities to the upside, which is going to help us push right back up bullish. So sometimes I like to use this now as an additional confirmation, because TranSpider gets their data directly from NYSE, Nasdaq, all that type of stuff. So it's legit data points. It's not just random supply demand zones or data points like that, like you would get with, just using Claude or just using ChatGPT. It's real information that you're getting there. Now we're going to do the same thing with Nasdaq, where you have that 30,000 mark, which is the previous weekly candle's top weight projection. This week, I'm not going to map out any of the levels here just yet. What we're going to do is drop down to the daily time frame and map out the support from Friday. And that is your 29,400. Drop down to the 4-hour time frame. We have a nice bullish momentum starting off from Thursday going into Friday and even today to the upside. If I look to the left, I don't have really anything to worry about in terms of going into London session. We just have a nice bullish momentum to the upside. We can come over here and pull up QQQ and do the same exact thing, go into the daily time frame. You have massive supply zone sitting up top there, and then demand sitting right here on the daily time frame. Go down to the 4-hour time frame, and we just had some buy opportunities on Thursday, hence the push up that we are starting to see. And that supply zone is also shared across the 4-hour time frame. So that's the same exact thing that we're seeing here, the 30,000 level that we mapped out. So let it continue to the upside. You have a nice bullish momentum. Watch what happens at that 30,000 mark. If price rejects off of this level and then pulls back down, then we're essentially looking for a zone-to-zone trade to come right back down into this 29,400. If price can break above that, give you a break and retest, hold on to this area as nice support. Then you have those clean buy opportunities to come up for another 400 points or even potentially 600 to come back up into those major supply zones that we just saw in TranSpider. Small caps. So we're sitting at all-time highs right now with small caps into this consolidation zone to zone, it seems like. So we have last week's top weight projection sitting at 30,050. Drop down to the daily time frame. You have a support right here from last week, right at that 3,000 mark. I'm going to drop down to the 4-hour time frame, and I see on the 4-hour time frame that we've had a little bit of resistance here. So I'm going to wait for price to break above that or below this 4-hour resistance into the downside. You can do the same exact thing and check it out in terms of where the institutions are sitting, where the orders are sitting. So in terms of small caps, it seems like we've had a nice bullish momentum so far. So nice bullish momentum, just it seems like a ton of buy opportunities that just came in or buy orders that price just tapped into, projected off of, and it's starting to push back up bullish, come down to the 4-hour time frame. So we had a nice bullish momentum on Friday to the upside. So it seems like we don't have any major supply zones here from the institution side, as if like the orders that have been placed already, we don't have any of that just yet for small caps. Let's come over to commodities, then we'll go over to currencies. Looking at gold, I'm going to map out last week's topic rejection. Drop down to the daily. And the support from Friday. Let's drop down to the 4-hour time frame. And on the 4-hour time frame, we have this entire support zone. Drop down to the 1 hour and adjust that just a little bit lower. So if price breaks below that support, then we know that we're continuing right back down into that 4,300, and then after that a continuation down into 42,600 area, which is this next consolidation. If price continues to hold on to support here and continues pushing back up bullish, then we're essentially looking for price to break above this consolidation and then take you up into 43.70 or even 43.80, and then a continuation back up bullish from there. Let's take a look at silver. Weekly time frame. Topic rejection from last week. 65.15. Drop down to the daily time frame. You've got a support right down here. 61.30. Drop down to the 4-hour. We have a nice little liquidity grab here from the 4-hour candle. How do you know it's a liquidity grab? We're going to look at the volume that follows after. Drop down to the 1-hour time frame, and you start to see how price is starting to break out of this core consolidation on the 1-hour time frame. What I'm going to do, just given where price is sitting right now, I'm going to map out that top wick rejection, that zone. If price continues to push back up bullish, we have those nice buy opportunities into the $65 mark. If price rejects below this and continues down, then we're coming right back down into this previous consolidation. Oil, we're not going to actively trade this, but I will still do the full analysis. So last week, we got a top wick rejection. 82.30. And bottom wick rejection. 74.30. Drop down to the daily time frame. We got a gap up already, and then the price created a top wick. Drop down to the 4-hour time frame. We kind of filled in that gap, not entirely. So if price can continue breaking its own highs, for those who are trading oil, you essentially have nice buy opportunities to continue right back up bullish into the 82.30 mark. If price drops back down, drop down to the 1-hour time frame. You have all this consolidation. So if price does drop back down, then you have this entire gap that the market still has to fill in, and that's your trade. Let's come over to GBP/USD. So on the quarterly time frame for GBP/USD, you can see how we have been consolidating really since 2025. So it's been about a year that price has just been sitting in this area into the support. 1.322 and the current quarterly top wick rejection. Now I want you to notice how price behaves here as we drop down to lower time frames. Onto the monthly, that's your core monthly consolidation that's going on. Onto the weekly, massive weekly consolidation. Now that doesn't mean that you don't have trades. This is still a massive zone, about 341 pips that you can still catch. What you're going to do is adjust that resistance to sit right on top of the previous weekly candle's top wick rejection into that 1.351 area, and then you have that bottom wick rejection from last week. So this is the initial zone that you're trading in your entire range. If price breaks out of that, then you're looking at what's happening on the monthly time frame, the quarterly time frame, all that type of stuff. But if price continues breaking below, let's say its own daily low, and continues to the downside, you have this entire sell opportunity for about 64 pips to the downside. Drop down to the 4-hour time frame, and you have this current zone. You want price to continue breaking below this, so then you can cash those 60 pips to the downside. If price establishes a support here and continues pushing back up bullish, you're waiting for this resistance here to be broken, and then you have your nice buy opportunities. Your USD, same thing. Take a look at it on the quarterly time frame. Essentially, the point of showing you the quarterly time frames on the currencies is so that you can see how every major economy, every major central bank is kind of dealing with the same issue, which is inflation, and inflation being impacted by the energy prices, the conflict in the Middle East, and all that type of stuff. So there's a lot of consolidation as you're dropping down to lower time frames. As you're seeing massive wick rejections, all that stuff. Don't get frustrated because right now the market is essentially collecting orders and trying to find its direction, right? So just know that whenever price does break out of it, there's going to be a ton of volume and great opportunities for you to catch. But always use the higher time frames to really figure out what's your direction here. So even on the quarterly time frame with Euro USD, you have the support at 1.138 and that top wick rejection from this quarter here already into 1.158. Drop down to the monthly time frame. This is the current monthly candle's top wick rejection, barely a doji here. Drop down to the weekly time frame. Last week, barely any direction or good bullish momentum. This week, we just started off pushing bearish, so no top wick whatsoever here still. What I'm going to do is adjust this so it sits right at 1.15. Drop down to the daily, and you have this entire consolidation. So I'm not really touching Euro USD at all. Even on the 4-hour time frame, I'm just going to let it first create its own higher low formation and then a push back up. That's a nice buy opportunity. I'm not really looking for the sell opportunity to the downside. I'm just going to let it find its direction to the downside, or if it wants to continue consolidating. So even this messy price action to the upside, a lot of consolidation. So I'm just going to let the major pairs do their own thing at the moment until CPI comes out. Be very careful when it comes to any of the yen pairs this week still. So GBP/JPY, you have the support here, previous support, previous resistance as well. So map that out, which is going to be your 212.7. Drop down to the daily time frame. You got a nice break and retest here, even from Friday, pushing back up bullish. Essentially, the area that I'm interested in is right up top here, which is this entire consolidation that's being locked in now. And that's 214.1. If price can continue pushing past its own daily highs, then you still have a range of about 67 pips that you can catch. Drop down to the 4-hour time frame, 1-hour time frame, and you have this previous resistance. So price needs to break this, so you catch those 60 pips to the upside. If price breaks below its own low and this previous resistance and continues to the downside, then we have those nice sell opportunities coming up for about 30 pips, but the entire range being about 60 pips as well. And here is USD/JPY that we are watching so closely. Weekly candle open, 157.7. Drop down to the daily time frame. Once price breaks its own high here, if you look to the left at where my cursor is, it's all that consolidation. It's going to break into that consolidation. Once it does that, this is the range that no doubt it's going to tap into, which is going to be that 160.5 area if price can continue pushing past that. So the first area of target, even for a scalp, is this. If price can break past that, then we're going right into that consolidation zone up top there. So that's going to be the next target area for us. So these are all the pairs that we're looking at that's on the list. So let me leave you with one idea that I want you carrying into this week. And first thing is, don't try to predict Wednesday CPI. Instead, try to understand what the market already believes before CPI gets here. Friday's job reports already pushed investors towards a more dovish Fed view. That means that softer inflation would largely reinforce a story that the markets have already started pricing. Hotter inflation would challenge that story. And that is why the potential reaction is not necessarily symmetrical here that we're looking at. So remember that probability and payoff are very different. The outcome you think is most likely is not always the outcome that's going to matter the most for your risk. So that's what separates reacting to economic headlines from actually building a market framework around them. On Wednesday, we will be trading live on YouTube at New York Stock Exchange Open, an hour after CPI comes out during the high volume time. So we'll watch the reaction across Treasury yields, the dollar, equities, gold, and the major FX pairs in real time. And more importantly, I'll show you how I decide whether that reaction actually creates a trade or whether the better decision is basically to stay out. So the weekly outlook is basically here to give you the map for the week, for you to also do your own analysis, really understand what's all happening. And in the Wednesday weekly live sessions, you get to watch that map update in real time. The session is free. It is on YouTube. So I'll see you guys on Wednesday.